friends. Welcome to the latest edition of Fund Manager View Show at Emkay Investment Managers. I am your host Kyra Ahuja, and today we have with us our prolific fund manager, Mr. Sachin Shah from Emkay. Good day, Sachin.
Hi, thank you.
How are you doing today?
Good.
Equity markets have delivered double-digit returns over the last few years. As we stand today, India's GDP is projected at 6.5% and markets are at lifetime highs. How should investors think about equity investments in financial year 26?
Yeah, actually, if you see the first half has been a decent start. From April to June, I think markets are up good 6, 7, 8% already. Which is a decent start in spite of the last August month not being so good, or September also not being that great. But overall, if you see, the first half has been good. I think the most important thing is in terms of the visibility, right? So if you see over the last now almost 7 months, a lot of interventions have happened from the government side, from the regulator's side, and I'm talking more from the domestic economy perspective at this point in time. So if you see, it started with actually sometime in February 2025 with the budget, where we had some tax relief. After that, we had a fantastic monetary policy, both ease of on the liquidity and interest rate cuts. We have had a great monsoon, and now, of course, in this month we've had a super duper bonanza as far as the GST is concerned, and which is really very large. So to my mind, we are going to see a fantastic, I would say consumption-driven economic growth. And of course, once we get into that for next 2 or 3 quarters, as an economy, we will get into a virtuous cycle of consumption leading to higher capex, right? So I think we are getting into a earnings growth, which has been a bit of a subdued for the last probably 2 to 3 quarters. But my sense is that in the next 3 to 6 quarters, we will see this reviving in a very, very big way. The corporate earnings growth should be very, very strong second half of FY26 and more so FY27. Something that market has been looking forward to for a while now. So I think that is something which is, in the offing, right? So I am extremely positive. And from that perspective, I think, and if you see again, if you just take the last 12 months, right? So markets have been broadly flat to marginally negative. So in that sense, we've already had some bit of time correction. And of course, company specific, sector specific, there would be also price correction. So in pockets, we've seen time value correction. And if we have the visibility, and like that is what we believe, the earnings growth is going to be very strong, then probably the timing is today very, very tempting to increase equity allocations.
Right, but having said that, the global environment remains volatile with geopolitical tension, tariff wars. Which risks are high on your radar? And how do you see this impacting your investment strategy?
Sure. So, I've been on record for almost last 2 quarters now that most of the things are playing out as far as the domestic economy or domestic consumption or domestic capex is concerned, in line with what we would like it to be. The only joker in the pack for the last 2 quarters has been the US tariffs. And obviously, it's playing out as ugly as one can think of as far as India is concerned. But our sense is that this is very, very temporary. If I have to take the next 3 to 5 years of view, I think the businesses that we have, whether it is contract research and manufacturing, in terms of specialty chemicals, pharmaceuticals, or even in terms of your auto ancillaries, textiles, electronics manufacturing, even engineering, within engineering, hardcore engineering, or say power equipment, all of these places, I think there are at least 7 or 8 industries where Indian corporates have established a right to win for the global markets, because they have delivered economies of scale, they have the domain expertise, and they of course also respect the intellectual property rights. So I think global customers are more than happy to work with Indian manufacturers, and I'm sure there is going to be some settlement as far as this tariff structures are concerned, and India will not be very different than most of the other competing nations who are manufacturing similar goods to export to US. Along with that, I think the other good thing is that a lot of lot of pending FTAs, right? Whether it was with UK, whether it's with EU, whether it's with Australia, I think all of that are getting accelerated. So I think there are so many new other opportunities that are opening up. So if I have to take a view, or if I have to go a horizon beyond the next probably 2 or 3 quarters and think about the next 3 to 5 years, then I think clearly we are getting into a much better environment. So I think the only risk that we worry is something for the very short term, which may have some bit of challenges as far as our forex reserves or our balances in terms of having some, and we are already seeing that some bit of pressure on the currency. But I think even over there, I think we are almost done, because we've seen almost 3 to 4% depreciation of the rupee versus dollar in the last 1 quarter and even for the year to date. So I think that's a fair, it's already done. And probably from here on, I think it should get much stable and better.
Perfect. Also, Sachin, in your recent interview with ET Now, you mentioned that macros are in favor of rise in consumption. So do you think we will see that in this earnings growth, or will we have to wait for another quarter?
Yeah, so I think very clearly, see, what happened is that when the Prime Minister actually announced the GST cuts on 15th of August, obviously, anybody who was looking to purchase at least high ticket value items would go a little slow, because they would wait for the actual deliveries, right? And now that the cuts have come sometime in the end of September, 22nd of September, which is the last week. So I think, and the festival season is there in October, November, December. So I think the clear boost that we are going to see as far as the consumption demand is concerned is going to be Q3 and Q4. But of course, the important thing is that in the earnings season, which will start post of 15th October, and a lot of that will also be, I would say, in the fourth week of October, post Diwali. I think the management commentaries, that will be very much there to give us a color in terms of how the consumers have actually are actually capitalizing on this fantastic GST cut that we are seeing. Also, we have to see that as the Kharif season is done, the harvesting is done, there will be more cash flows in the hands of the rural India, and then of course with good water levels, even Rabi is expected to be good. So even Q4 of FY26, which is January, February, March, is expected to be much better. So I think second half FY26 is the right time to actually see the numbers. But even today, when we see some of these auto companies, say for example Maruti, the largest manufacturer in this country, they have been very clearly saying that they are already witnessing twice number of bookings, twice number of inquiries. So I am fairly confident that there is going to be tremendous amount of consumption revival as we go ahead.
Right. Within India, we've already seen a strong performance from be it financials, be it manufacturing, or be it the new age tech. What are your 2 or 3 sectors, which you feel are doing better?
Yeah, so Kyra, actually, we have been fairly overweight in all 3 of them that you mentioned. So, as far as autos are concerned, we are playing the premiumization theme there for a while now, both in the two-wheelers and the passenger vehicles. Today, we have a very decent exposure to Eicher Motors, which is the 350cc and above, the premium two-wheelers. We have a very decent exposure to Maruti, which is again, we are trying to play the higher SUV share for them as they keep on launching new and newer models. As far as the manufacturing concerned, again, we have very decent exposure. Again, auto is part of that. but also I think we have exposure to pharma manufacturing, particularly the contract manufacturing companies, the CDMO and the CRAMS, the contract research and manufacturing companies, whether it's DV's Lab, Laurus Labs. And on the new age businesses, again, we have been investors in a couple of businesses, whether it's Eternal or Delivery. Both these companies where we have very decent exposure across the portfolios. So, and all of this somewhere is linked to discretionary consumption, barring the pharma space, which is more to do with the mega trend of China plus one, Euro plus one story. So I think each of these sectors, we continue to believe where there is a secular trend. In fact, it's a mega trend to our sense, because from a domestic perspective, I think the combination that we have in our demography in terms of the young and the aspirational population, I think that's a lethal combination from moving from consumption to consumerism. And each of these businesses are fantastic play over there. And of course, the other mega trend is in terms of the outsourcing side, so which is where the manufacturing piece comes into play. So we are very, very positive on each of these sectors or themes.
Perfect. Moving to our strategy, MK Capital Builder. Capital Builder is known for its long holding periods, process-driven approach, and 70% of the portfolio being held for more than 7 to 10 years. So Sachin, what has been your approach for newer opportunities to create alpha in this strategy?
Yeah, sure. So, again, there is always, so 70% of the portfolio, or maybe even 75% of the portfolio, we have a vintage of almost now 7 to 10 years. Because the whole fun of investing is the game of compounding, and that is what we bring to the table for all our investors. So unless the underlying ownership where we own, unless we are owning them for a longer period of time, it's difficult to get the compounding in the portfolio. And that's how we've actually multiplied, say over the last 12 and a half years, we've delivered 7 times returns, which is good 17% plus compounded returns for our investors, with one of the lowest churns, with one of the lowest tax payouts. So I think that has played out well. But of course, this is just 75% of the portfolio. The balance 25%, at some point in time, there are always few churns that are few active calls that we need to make. And say for example, Delivery is a portfolio stock that we've added in the last 6 months. Maruti is something that we've added in the last 1 year. Eternal is something what we've added in the last 2 years. We've added a new consumption stock, which is Zydus Wellness, in the last 6 months, or maybe I think it's in the last 6 months. So, like this, and the very recent business that we've added is Shriram Transport, which is in the last quarter itself. So, like this, we will always try to keep on finding some new compounders that we believe can give alpha kind of generative returns for our portfolios. And obviously, when we try to do this, we make sure that we never compromise as far as the management quality or the business quality is concerned, because we believe these are two pertinent things for any compounders in the portfolio. So we are fairly conscious about that fact.
Right, that is rather impressive. But moving on to a philosophical question. So you have to answer this with a philosophy, right? But how are you evaluating emerging trends like, say, the artificial intelligence, AI, or energy transition?
Yeah, so see, these are again very new age businesses, which is, if I were to draw an analogy, when we invested in Eternal, there were a lot of questions asked that, how is this business model fitting into your equal? How does it fit into your track record and those kind of things? And our basic thought process again there is that we have to be where the consumer is queuing up, right? If the consumers have, as far as most of these new age businesses are concerned, whether it's Eternal, whether it's Delivery, whether it's Nykaa, whether it's the quick commerce, the Blinkits and the Zeptos of the world, I think the consumers have not only accepted this, but they have actually embraced these businesses, right? Now, Now, when you talk about some of this renewable energy, when you talk about data centers, AI, all of this. So I think these are again things which are, we are literally living with these things day in and day out, right? Today, so many houses that you will see across the country which have solar rooftops, right? So many industries which have now at least 25-30% of their consumption is through renewable energy, right? We see in so many fintechs, right, which are completely dependent on AI, right? Today, most of the mobile apps that you are working with any bank, whether it's ICICI Bank, HDFC Bank, Axis Bank, even State Bank of India, all of them will have a lot of AI which is working in the background. So these are things which we are thinking, which are futuristic, but to our mind they are already happening. So from our perspective, once these adoptions are done, we have to find our way out in terms of how do we participate in these businesses, because the belief is that if you have the right value proposition, if you have the consumer and the customer who has embraced this value proposition, at some point in time you will figure a way out how to make money out of this.
Perfect, Sachin. Thank you so much. I think that was a rather enlightening session that we had, Mr. Sachin Shah. Thank you, friends and viewers, for watching us. Wishing you all very happy festive season ahead. And until then, happy investing.